Yeah, so they had it for about 20 years, right up until 2018, when the renewal sort of negotiations between the two companies got contentious. Walmart was demanding too much for Synchrony, and so Synchrony sort of backed out. And at the time, it was a really big deal, and so this is an equally large deal that they're coming back.
Why did it go away?
So the way Synchrony works is they have these large partners, right? The top 5 partners are more than 50% of their net interest in fees. And what they do is they share the economics with the partner programs in something called a retailer share arrangement. So every couple of years, the partnerships are up for renewal, and Walmart is a gigantic corporation. They have huge leverage, and they were demanding essentially more of the economics than Synchrony could provide and still be profitable.
Ben, talk to us about these kind of branded credit cards, if you will. I mean, my daughter is a master at managing points and doing all that kind of stuff.
It's like a full-time job.
It is, but it pays off every time she's traveling somewhere. It's on points. It's on points. Talk to us about that, the business of those kinds of cards and kind of the economics.
Yeah, so Synchrony is not so much in that business. They're in the business of providing a credit option, usually to sort of a lower creditworthiness, lower income borrower that is really focused on a single retail partner. So this partnership is going to be, there's going to be 2 cards. One's a general purpose card that kind of does what you're talking about, but the rewards sort of value proposition will typically be a little bit lower. The card will be more accessible. And then the other card will be just used at Walmart. And details are still pretty light on what the reward structure might look like, but the goal is to drive throughput at Walmart and not necessarily at sort of other retailers.
So they also have cards with like JCPenney, Lowe's, Amazon, PayPal, for example, and you mentioned sort of a different type of band of consumer. How is that band of consumer doing?
So Synchrony likes to say that they're managing, they're not thriving, and they're not struggling. This is it's sort of like a subset of wallet share, right? So this is the Synchrony is just seeing how these consumers are behaving at a single retailer for the most part, but there's not a lot of stress. But if you look back at 2018 when they first decided not to renew the Walmart partnership, it's kind of overnight their charge-offs went down like 60, 70 basis points. So presumably this particular customer set is charging off a little bit higher, like maybe 1 percentage point higher than your typical borrower. So there's going to be, it's an interesting time for Synchrony to go out and look for these sort of more marginal buyers, basically to get growth.
Ben, your coverage of consumer finance companies, you get a good view, those companies get a good view of how the consumer is doing, how they're spending their money. What are you hearing from these companies these days?
So if you look across spending categories, everything is still typically growing a couple percentage points above GDP. There's one obvious standout, which is travel, which is basically people cutting back on their most incremental spend. But if you kind of think about travel, right, you're booking your flights a couple months, maybe a year in advance, and growth in that category is down double digits. So if you kind of extrapolate that forward, will we see a similar shrinking in hotel spending, entertainment, leisure, things like that? Could be a little bit of a canary in the coal mine.